All right, it's my very great pleasure now to introduce one of New Zealand's foremost economists to the Fieldays TV couch. It's not really a couch, Cameron, it's more of a Spartan-like plywood structure that we are perched upon. Cameron Bagrie was the chief economist at ANZ for 11 years. He now runs Bagrie Economics, a boutique research firm that specialises in independent analysis of the New Zealand economy. Cameron, welcome.
Oh, great to be here.
I'm not going to ask you about whether or not it's a good time to buy a house. Is that the most standard question you get asked as an economist?
I wouldn't say that. Probably a little, what should I be doing with my mortgage? That's the one that comes up time and time again.
Well, I'm not going to ask you about that until the very end. Hey, look, they say never waste a good crisis. We're in a crisis at the moment. We've been in crises before. Last one, the GFC. What did we learn from the GFC?
I guess the big lesson about the GFC was the importance and resilience of the banking sector. If I go back and have a look at what we went through, the New Zealand banking sector needed a $133 billion government guarantee. The Reserve Bank gave them $10 billion worth of additional wholesale funding. They bought about $8 billion worth of loans off the bank just to give them liquidity to get through a pretty big credit crunch. Now what did we do ex post? We made the banking sector more resilient. So the Reserve Bank brought in new rules such as the core funding ratio, which is a fancy way of saying hold more deposits. There are a few other sort of tweaks, and of course banks add bigger regulatory capital. They built those buffers, and we got a little bit of arm twisting, a bit of a debate last year between the Reserve Bank versus the banks in regard to should the banks hold more capital. Well, the Reserve Bank won that one hands down. And where do we find ourselves today? Well, the banks have actually been in a position to support the New Zealand economy, which has been critically important.
Is that different from overseas? Are we in a different position to, say, Australia, the States, the UK, in terms of that?
Not just that, but I think one of the big differentiators between New Zealand and a lot of other countries around the globe at the moment, probably excluding Australia, has been the strength of the government balance sheet. So we walked into this with government debt around 20% of GDP. So what are we doing at the moment? We are loading up that balance sheet. In fact, the money's going out the door like confetti. It's been spread around. Now that's the right policy response in the near term. Other countries around the globe do not have that luxury. Some big countries around the globe have got government debt up around 100% of GDP. Well, they're borrowing more, but boy, are they going to have a bigger problem down the track.
So essentially, they were saying, as the last couple of years, that a lot of those reactions to the GFC are just not possible now because everybody's tapped out.
Well, yes and no, because what we're doing at the moment is, we are absolutely putting the global economy on steroids. If you look at what we're seeing at the moment, just take New Zealand, for instance. The government borrowing is going from about 60 billion to 200 billion. That's net debt by 2024.
It's fine though, isn't it? Money's cheap. Money's cheap at the moment, and we need it.
As I said, it's the right policy response, and we do need it. But let's not forget, that's an intergenerational wealth transfer. Some generations are going to have to pay that money back down the track. So the more we support the economy in the near term, the more we as a future generation of taxpayers, the kids and their grandkids, and we're going to get into a debate in the coming sort of few years about who's going to wear the cost of this down the track. What we're also seeing is that your central banks around the globe, they're out there printing money, engaging what's called quantitative easing. Now, once again, it's a good policy response with a couple of caveats, because it's reflating asset prices, it's helping the global economy out. But what we've got at the moment is a pretty big disconnect between what's called Wall Street versus Main Street. So equities are up, they've recovered. They were down a little bit overnight, but generally speaking, they've bounced helplessly hard since March. Even house prices started to bounce back up. But you look at the Main Street economic indicators. Well, the Main Street indicators are, do you have a job? And we've got this big disconnect, and we've got to be pretty careful in regard to that because society could start to push back.
They will, and I don't think we've yet seen the number of people who are going to lose their jobs. I saw a stat the other day within, I think, in the States, they say there could be another 20 million homeless by the end of October. So you are right. I don't understand the stocks and the bonds. You see a lot of Trumpers on there saying they're doing fantastic. Why are those things doing so well when, if you look around, ordinary folks, those ordinary businesses, ordinary shops, struggling?
Well, part of it is purely because the likes of the equity market, for instance. Look, the equity market is forward-looking. So it's looking towards 2021 and thinking, hopefully we're going to turn the corner. Hopefully we're going to get a vaccine. Hopefully we don't get these multiple waves. Now, that's hope. it's not certainty. What we also know is that there are a whole lot of other risks there in regard to what could unfold on the other side across the real economy. Interest rates are ridiculously low. Walk into the bank and see what you can get for a term deposit. Well, there's not too much of an incentive at the moment to put your money in the bank, so it's finding its way into other asset classes. But that's a dangerous, that's a risk as well.
Yeah, and they're talking about negative interest rates. What does that actually mean? If I've got a deposit, do I have to pay the bank to look after my money? What does that mean for an ordinary person?
I call it Looney Tune economics. We've seen it take place in Europe. We've seen it take place in Japan. Has it really made a difference? I'd say the answer is no. It's been put on the table here. Thankfully, we're seeing some central banks, such as the US Federal Reserve, the Bank of England, the Reserve Bank of Australia, have pushed back. Now, they haven't ruled it out completely. Why? Because extraordinary economic times could call for extraordinary economic measures. Yeah, but New Zealand's not like Europe. New Zealand's not like Germany. New Zealand's not like Japan. Yeah, we don't have a huge savings portfolio. Yeah, we tend to like to spend as opposed to save. Yeah, so we need to have positive interest rates to sort of bring money into the country.
Looking at the COVID crisis and particularly the New Zealand economic situation, as an economist, has your sphincter clenched with terror, or are you optimistic? Is that an economic term that you use? Sorry, I'm not really an economist.
You got to be pretty careful because it's a question of balance. Yeah, I don't think chicken little sort of analysis helps, but we've also got to be realistic in regard to what's going on here. Yeah, let's sort of step beyond COVID. In my personal view, containing COVID, particularly in a place such as Australia, is a little bit like trying to control the flow of drugs. Good luck with that. I think the reality is that it's going to work its way around the system. But if we step back and think about pre-COVID versus post-COVID, New Zealand's economic model was on borrowed time. Obviously, we've been sort of pushing a short-term agenda for growth as opposed to thinking about the long-term prognosis for growth, matching up sustainability. About 1/3 of New Zealand's growth over the past 5-10 years has been driven by immigration. Tourism has been a big driver of growth as well. Volume growth across the dairy sector has been a big driver of growth. Big companies, these multinationals. You think about what's going to be the economic cost of the downshutting of Tiwai Point, and I think there's going to be other big industrial plants that go as well. So as we move out the other side of COVID, we've got some questions in regard to health readiness, but we've got to answer some big questions as well regarding what's New Zealand's economic model going to look like. There's some numbers came out the other day out of government. They're talking towards the primary sector in regard to the roadmap, that sort of thing. But if you actually look at the numbers, the numbers show primary sector exports, assuming we adopt that roadmap, going from about 16 to 14% of GDP. Now, the rural sector is not going to be leading the economic charge of recovery in New Zealand over the next sort of 5 to 10 years. So you've got to ask some hard questions about, well, your aspiration is fine, but where does that roadmap rubber hit the road in regard to what is New Zealand going to look like in regard to job creation?
What is it going to look like? Immediately, who would be the most exposed at this point in time?
Well, the businesses we're seeing across New Zealand that are most exposed is obviously the tourism sector. And the tourism sector hasn't really seen the nasty fallout of COVID yet. If you ever look at over the winter months, there's normally more New Zealanders that travel overseas than foreigners that come in. Well, we can't travel overseas, so we've actually got this bucket of people at the moment. And everybody from Auckland rushed off down to Queenstown in the last sort of week or two. If you're not taking a holiday, though, you're out there spending money on something else. And I'm hearing spa pool sales have gone through the roof. So we're starting to see those sort of quirky sort of things in regard to there's money that's still circulating around. But if you look at when the tourism sector is really going to struggle, it's going to be November, December, January, February, March next year, because that's normally we get this big inflood of foreigners coming in relative to New Zealanders going overseas. So watch out, because if we don't get those trans-Tasman bubbles or open up the borders anytime soon, that's when the rubber's really going to hit the road. And I guess, relating that back to the rural sector, what does it mean? If we take out tourism, if we take out education, and manufacturing, parts of it are going to get gutted, we're going to be pretty critically reliant upon the primary sector to drive growth. Now, what we got in the last sort of week or two is a bit of a roadmap that, It's got a little bit of A for aspiration about it, but it looks to me pretty light in regard to what that aspiration needs to be if the rural sector is going to be at the epicentre of the recovery for New Zealand.
If you were writing a roadmap, we've given you the keys to the car and the pen, what would you put on that roadmap?
Oh, there's an awful lot. Probably the portfolio that, if I ever got into politics, and there's zero chance of that taking place, would be education. I want to build the resilience of tomorrow's investors. One of the big themes that I think we've got a massive problem across New Zealand at the moment is financial literacy. The financial skills of small businesses. If you look at small businesses across New Zealand, businesses that turn over less than 5 million, they've got cumulative turnover of about $230, $240 billion. Now, about 1 in 5 of those businesses in 2018 was losing money. Now, that was sort of the peak in the economic cycle. You got 1 in 5 that are losing money. And there's about $4 billion worth of money that's sitting there interest-bearing on credit card debt, taking a rate of sort of 17 to 18%. You're sort of asking yourself, what is going on here? There's no quick fix to where New Zealand needs to go. I've seen, political parties that are out there throwing money at things, infrastructure is sort of top of the pile, education. We're going to talk about tax reform, we're going to talk about health readiness. But I guess in spirit, what we need to do, to stand tall, you've got to think small.
When it comes to farming, the rural sector, there's cash flow, of course, and that's buying them a little bit of time, I suppose, to sort out some of the debt issues. So if I have a look at the start of the COVID crisis, 3 things were key. And the 3 key things were liquidity, cash flow and risk management. And the rural sector, I think, had a pretty good handle around the liquidity and the cash flow. But what we've seen across the rural sector at the moment, thankfully, commodity prices have held up really well. And I think most people would have thought we would have suffered a lot more as the global downturn has really started to kick in. So glass half full in regard to they've got the cash. But what we also know is that the rural sector at the moment is pretty two-tiered. You've got some parts, the likes of the dairy sector, they've been under a fair bit of financial strain for a while. Why? Well, you've got an asset bubble that just pushed a little bit too far ahead of itself. And you've got various environmental constraints now in regard to volume. You've got freshwater constraints, yada, yada, yada. So they need to think about their economic model. But what you've also got is in excess of 60% of dairy debt is interest only. They're actually not paying down the debt. Now, that's off the charts compared to what we see within owner-occupied lending or residential investor lending or the business sector. And so what we're seeing across there, the banking sector and the dairy sector, let's just say they're having some discussions. Some of them are not what you call friendly, and we need to see a little bit of pragmatism on both sides in regard to what's going on. But so far, we've seen dairy sector debt. It's coming gradually down, and that's actually a really good thing. It's happening in an orderly fashion. Because you do hear anecdotally of the banks trying to extricate themselves from that sector entirely, which I guess at this point in time, would that have changed over the COVID situation when they're suddenly thinking, oh, where else can we look to lend money to?
If I think about the banking sector at the moment, I don't think the dairy sector is going to be their biggest problem in the next 12 to 24 months. If
there's a positive to come out of this pandemic, it's that the banks are off the back of the farmers.
The biggest problem is probably going to be the commercial loan books. There's about $40 billion worth of commercial debt, but the farmers have got a little bit of breathing space for now. But farming debt, particularly in the dairy sector, it's still too high. It's probably got to go from 40 billion down to about 35.
Well, I suppose if debt wasn't high, the banks couldn't make those record profits.
Well, exactly. But thankfully, they're making those record profits because they're going to take hits in the coming 12 to 24 months.
They are. Now, look, there's a lot of attention around the whole COVID situation, but is that actually serving to mask a whole lot of other problems?
Yeah, there was. So if you ever look at what we were seeing, pre-COVID, we were having a bit of a debate about New Zealand's economic model. And New Zealand's economic model needed to evolve, needed to shift. And COVID's probably a little bit of an accelerant for that. But we were seeing some pretty big spats that were going on as well. The debate between the young versus the old, and housing affordability was at the epicentre of that one. Well, we'll now think it might be a little bit about jobs. Where they've actually got one. There was a big debate in regard to between labour, the workers versus corporates, and whether corporates were taking up too much of the so-called economic pie. So a lot more push between fair wage, lifts in the minimum wage, capping CEO-based wage, urban versus rural. It'll be interesting to see if the urbanites, and I'm an urbanite, if we had to have a household management plan, the equivalent of a farm management plan, and what would that actually look like?
Well, it would be fascinating, wouldn't it, if you had to put out a little document each month as to what you were going to do with all of the things, your recycling and whatnot that you've brought in, all of your inputs. Where are they actually going to go?
Oh, exactly, and let's not forget it needs to be audited and be ticked off as well.
I tell you what, if there is a room for a growth industry, prior to COVID, it was auditing of some kind. Let's audit everything.
Well, the
new auditing class.
Yeah. But the rural sector, we've probably still got a wee way to go, but the fog is generally being clearing in regard to what the rural sector needs to do. If I look at sort of city folk, urban dwellers, boy, is the fog starting to settle in. And we need to face a little bit of economic reality in regard to what our responsibilities are.
That's exactly right. When it comes to these spats, and we're particularly looking at that kind of intergenerational wealth thing, what's COVID going to do to those? We're seeing house prices, if anything, going up currently, whereas the jobs are sort of going down. There's still discussion around whether fair pay can be a thing, the living wage. I know Auckland Council, I think they said, we're still going to pay the living wage, possibly as a deflection to how much they're paying their new chief executive. Are those spats going to go away, or are they going to be strengthened or exacerbated?
I worry that they could be exacerbated. Because what's going on at the moment is we're seeing a big coordinated policy response, particularly by central banks. You're flooding the system with money. Now, it's the right policy response to try to support economic growth. But supporting economic growth comes with nasty side effects, because one of the nasty side effects is that lower interest rates are very supportive asset prices. Who tends to own the assets? It's people that are on the property ladder as opposed to those people that are not. And those people tend to bear the brunt of rising unemployment. Where we've been for the past, probably 20 to 30 years, we've been very focused on the outright economic or capitalism side of the ledger. And what's going on at the moment is we're starting to think a lot more about the long game as opposed to the short game. And that's a better economic model. In fact, it was an economic model we had about 20 to 30 years ago. What's just happened is that we've gone a little bit too fixated with what's called shareholder capitalism, which is just a fancy word for making as much money as you can in the near term, whether that be through dollars or volume in the space of dairying, and starting to think a little bit more about shareholder-based capitalism. And shareholder-based capitalism is thinking a lot more about your people, your customers, the environment, your community. Now, you're still going to be focused on making money, but it's within a long-term horizon as opposed to the short-term.
Have we seen a little bit of a rise or a change in that? We've seen, for example, Stuff have, they look to sell, and in the end they essentially ended up buying themselves and having stakeholders. People are floating the idea that perhaps there could be a whole lot of sort of stakeholders buying into TY Point, which may just let a multinational offer $250 million cleanup. Who knows? Is there a change there with people thinking, why don't we have the people in our businesses investing in our businesses?
Well, extraordinary times are going to call for an extraordinary response. And so if I look at TY Point as an example, everything's going to be on the table. And we're probably going to need to be creative in regard to what those solutions are going to be. Stuff buyer, another example of a creative solution. But this is a downturn like no other. Now, it's not just about a lack of demand, it's been about physical lockdown and shutdown. There's actually demand out there. The problem is supply, not demand. But what we're seeing at the moment is that firms are facing cash flow pressure. Less so within the rural community, but more so particularly within SMEs, tourism, retailing, and some of these sectors such as retailing. Look, in all honesty, we were moving more towards online shopping. It was going to take place anyway. All that COVID is going to do, it's going to accelerate. It's going to take what was going to take us 10 years is now going to take us 12 to 24 months. The same with bank branch closures. The banks, I think, probably had a plan in regard to we're going to sort of knock that one off, X number of time over the next sort of 10 years. What's the next 12 to 24 months? The crisis tends to bring a pretty big appetite for change.
What does that do for your little small businesses that are trying to compete against your big online outfits? I'm thinking of a clothing retailer, for example. You could order off the likes of ASOS. It would arrive incredibly quickly. You try it on, you think, oh, I don't really like that, and you can send it back to wherever it came from in the prepackaged thing for free versus, some poor little retailer who doesn't have that platform. How do they compete in that online market?
Well, I guess it's not just about retail. Now, if I sort of think about where you want to be in business, you sort of got two places. You be really big or you be really boutique. It's when you try to sort of mix your drinks in the middle, it tends to become pretty damn difficult. Now, New Zealand firms don't have the size, the scale to compete on a lot of levels, so what do we need to do? Think, what are our boutique leverage points? What are we going to do that's fundamentally different, that's going to connect to the consumer and make sure that they want to buy from us as opposed to something else?
Sounds like a very good analogy for the rural sector as well.
Oh, look, exactly. If you think about your pasta to plate or global connectivity, New Zealand's got a great story. I guess the next leg is in regard to, it's not just about telling that story, it's about branding it and taking it around the globe.
You've talked about stakeholder capitalism. Does that align with the rural sector?
Yeah, I think it does in regard to that they view themselves as, well, they're stakeholders in the land. In fact, they're guardians of the land. Connects very well with the whole idea of Maori across New Zealand as well. So if I have a look at the rural sector, the shift from a shareholder-based model to a stakeholder-based model, I don't think involves too many big structural shifts. Probably where there's going to be the biggest structural shift is the dairy sector thinking a lot less about volume and about value, and we're moving down that sort of line. The sector that probably faces the biggest challenges is the banks, because banks, they want to have their cake and eat it too. They want to be in both parts.
Yes, they do. Hey, look, if you were of the younger generation, that's a patronising question, isn't it? Cameron, if you were of the younger generation, what would you be worried about now?
Short answer is a job. What is the economic future going to look like? There's a whole lot of ideas out there in regard to what the recovery is going to look like on the other side. V, we bounce out the other side, we're back into it. U, a little bit more protracted, and L, 1987 to 1992 sort of repeat. If you think about the younger generation, I've got two kids, 10-year-old and a 14-year-old. My 10-year-old came home into the room the other day and she had "OK Boomer" written up on the wall, and I'm like, geez, that's getting a little bit rough. I'm not in that part of the world. But you sit there and think about it as a parent, is what's the future going to look like for your kids? I can remember coming out of university in the early 1990s, and by hell it was hard. But what that made you focus on, because we knew what the environment was going to be like, you worked that extra a little bit harder at university, because you needed to get the grades.
To be fair, not all of us, Cameron. Not all of us worked harder at university. You've become an economist and I'm simply sitting here on a plywood box asking you questions. Life hasn't gone as I'd anticipated, but it never does it? If you were looking at that sense of job creation and growth, and not necessarily just for young people, where do you think that's going to go in the next little while? Because obviously there's a lot of people aren't coming in, that migration is difficult for a lot of those jobs. We're going to be sending people out to build all of these new roads and railways and plant trees and goodness only knows where. What's the future of jobs?
Well, we can put a bit of a roadmap on some areas. Obviously, anything technology-based is going to need to be turbocharged, and there's boutique parts of that if you think about gaming, all these sort of things. My 10-year-old told me 6 months ago she was going to be a YouTuber. I sort of raised my eyebrows a little bit, but to be fair, you can actually get a career out of that sort of stuff.
You probably,
we wouldn't have thought about that 5 to 10 years ago. But I guess the way I think about it is, we know there's going to be some real growth opportunities in some parts of New Zealand. I still think that the rural sector, the primary sector, is going to be at the epicentre of where New Zealand is going to need to be. We've got to harness the power of water. I think there's going to be some boutique opportunities in manufacturing as well. Not big scale sort of stuff, but boutique, small scale. And we've got to get a whole lot of other add-ons across industries. But raising a kid, the most important thing you can probably teach your kid at the moment is to be innovative, adaptive and creative. That's where those jobs are going to actually come from.
And how to manage their debt and cook something delicious and wholesome.
Well, exactly. I've got a real bee in my bonnet about financial literacy across New Zealand. If we look at what one of the learnings needs to be out of the current downturn, and obviously health system readiness, the resilience of SMEs is one, but I've used this as an opportunity to make financial literacy compulsory in schools, because to me that is a life skill. And if we want to build better capability across the rural community, sort of close that gap up between the strong performers and the underperformers, or have a look at the resilience of small businesses versus large businesses. It all starts with making them a lot more financially savvy and set for a different future.